When a corporation expands outward into new international markets, the primary focus is almost always on speed and market capture. Standard executive concerns regarding international expansion often center on exchange rate volatility, new tariff structures, or geopolitical friction. These are external variables that, while significant, are often outside a company's direct control. A more immediate internal threat exists: the back-end paradox. This occurs when frontline sales teams successfully secure international market share, while the back-office systems fracture under the resulting complexity. The symptoms appear in the daily workflow. Teams struggle to issue compliant Turkish e-invoices, investigate why a Brazilian payment fails to reconcile, or determine which reporting standard applies to a Japanese subsidiary. In many cases, the global rollout relies on localized spreadsheets manually passed between departments. This structural fragmentation drains operational efficiency, erodes profit margins, and reduces the certainty required for high-level management decisions. Scaling a market footprint requires a corresponding evolution in the underlying systems. A unified digital chassis bridges the gap between a business occurrence and a closed operational loop. Building this global base starts at the atomic level, a single cross-border transaction. An international order relies on an automated financial execution layer. To guarantee revenue, accounts receivable natively handles multi-country e-invoicing and localized compliance checks instantly. Accounts payable follow suit, using automated vendor verification and tax optimization to prevent expenditure loss. Automating the flow of revenue and expenditure serves as the prerequisite for operating across multiple borders. Individual transactions must eventually settle, shifting the focus to global cash management and financial settlement. Localized bank accounts in different jurisdictions create severe liquidity blind spots and extend the time required for settlement. A central banking hub integrates directly with local financial institutions to execute cross-border payments within a single environment. This provides leadership with real-time liquidity visibility across the global operation, removing the uncertainty of fragmented reporting. A centralized banking core allows enterprise leadership to see their global cash position clearly at any given moment. Compliance latency, the time gap between a business action and its regulatory reporting, represents a significant operational risk. Relying on manual month-end reconciliation for multi-jurisdictional tax and customs requirements is a structural vulnerability. If a risk is identified during a manual audit, the violation has likely already occurred. Embedding regulatory data frameworks into daily transaction flows creates a compliance shield. Systems like ProcessGo Plus operate within local rules engines from the transaction origin, verifying every parameter in real time. This automated model replaces the reactive approach of patching data together to prepare for an audit. Corporate compliance functions best as a technical constraint. When the environment itself prevents non-compliant actions, the audit becomes a routine verification of a healthy system. The global architecture must also extend to the physical operational realities of a multinational supply chain and workforce. A unified payroll system calculates localized tax and social security obligations automatically across different legal environments. Multi-currency expense management prevents micro-inefficiencies and manual auditing bottlenecks that often plague multinational entities. Multi-node warehousing synchronizes inventory visibility with logistics data for real-time product tracking. Simultaneously, optical character recognition extracts unstructured data from multilingual documents. Converting these foreign invoices and shipping documents into standardized data eliminates manual entry errors at the organization's edge. A multinational backend is only fully reliable when it automates the farthest physical points of its operational periphery. This structural transition binds finance, tax, customs, banking, and HR into a singular, automated continuum. True global scaling involves the ruthless elimination of isolated systems, replacing them with a unified framework. Enterprises currently use this framework to manage high-volume international operations across diverse markets. This chassis concept is validated by successful deployments in varying regulatory environments, including Anchor in Turkey, Sani in Poland, Wanwa in Brazil, and Envision in Egypt. Initial market entry relies on market-facing tools, but long-term profitability and consistency require systemic depth. While front-end aggression secures the first orders, back-end structural integrity dictates whether an enterprise can maintain its growth over time. Integrated global architecture serves as the foundation for multinational operations, providing the stability required to sustain growth in complex foreign markets.